Good morning, everyone. Thanks for joining us this morning. We're glad that we're going to be joined here shortly by Craig Geiger, our regional rep from Lincoln Financial Group. We'll be discussing brand new strategy they just introduced here recently with Lincoln Financial. He'll be discussing the finer points of that. Also go over some good sales ideas this morning with Craig. We'll try to keep this to about a half an hour in duration so everybody can get back to their daily routines. But we're glad that you could join us today on the webinar, and we look forward to any questions you may have during the webinar itself. Be sure to get those questions asked. We'll be glad to get those answers as we're working through the webinar itself. But thanks for joining us here on a Wednesday morning, and we look forward to a great day here today. So we'll go ahead and get started. And I know we have our new producer perks. We do have different levels of qualification you can earn based on your initial premium the first 180 days of being licensed. There's anywhere between a $100,000 level and a $1 million level. Obviously, as the more business you produce, the higher the values are on the individual items you can choose from. We have a lot of different seminar programs, Boss Radio, video campaign, Ritz-Carlton package, iPads. We got different marketing reimbursement levels. So a lot of good stuff you can really take advantage of based on your business in the first number of days here through IAMS. So a great way to get started and get some really nice incentives based on your production. So that's one thing we do have going forward here in 2020. We also have our business builders. We have our referral program. You get dollars based on referrals, and it's a $50 bonus when your referral gets signed up. You get a 20 basis point override on their indexed annuity premium, multi-rate guarantee annuity premium. You get 10 basis points on, and then you have life target and single premium life based on that production. You get money based on that. I know those checks go out quarterly, and I always have agents that call me every quarter trying to figure out what their quarterly payment's going to be. So it's really a nice program we have had in play here for the last number of years, and we have agents that have quarterly checks that come out in the thousands of dollars. So their referrals do good business, and then they earn some really nice money based on that. We also have our marketing reimbursement. Reimburse $100 for every dollar or every $100,000 of annuity index annuity premium. We do $200 for single premium life and $200 for $10,000 of life target premium. So it's really good market reimbursement numbers there. I know we reimburse based on your expenditures. So you send us a expense and we reimburse half that cost up to the total of market reimbursement you have in your account. So if you had $1,000 in your account, you send us receipts for $2,000. We'll pay out that full $1,000 out to you based on those expenditures. So really a nice program we've got going there. We also have our back office support. We've got a great group that work in the new business department. They do a great job on following your cases from start to finish, making sure that they're going through suitability correctly, making sure they're going through the transfer process, making sure you get paid in a timely fashion. A really good group of people we have on that end. We've got a great case design team here and our marketers. We've got a great group that helps you with creative side. Maybe you want to do website development, email drips. I mean, it just depends on what you want to put together. We've got a great group on that creative side that can help you out with that. And then we have a great contracting department that can help you get you licensed up with the specific carrier you want to utilize, do that paperless wise, and then maybe you can get able to get licensed up with a number of companies at one time if you wish. It's really a nice program there that we have available through IAMS. We got the Firelight system. It's our e-app system. I know we have more and more people utilizing that. We do have Lincoln Financial is available on the Firelight system. It really helps streamline things. The new home office, new business department doesn't have to weed through handwriting. You know, when you fill the app out, typically the program will not let you go forward unless you've done the complete page, completed it out completely. Whereas if you send apps in, you never know what you're going to get based on missing information. So I really like the EAP program. Once you've done it once, twice, it's really an easy process. Your clients can sign off electronically. You don't have to see them in person at this point, based on what's going on with the pandemic. That makes the whole process that much faster. And we have a very good group of companies that do utilize the whole Firelight system. We've got other ones that will be coming up soon. Will be added to the platform. But I think it's a great way for you to get business in and get it done in a timely fashion, and then have that process through the home office that much faster based on how those work. Got a great creative team, as I mentioned, that can help you with logo design, maybe changing up your business cards, doing website development, digital marketing. I know they're really good with Facebook marketing, LinkedIn marketing. You can look at social media consulting based on that. They've got some great good experience on doing email marketing, maybe using a drip campaign, whatever it is that you need to utilize on your side to increase your business, they're going to help you out with. And I know we've got some good postcard situations you can utilize, some really good information. I've got a guy that sends out postcards on the Medicare side. He always gets, a couple returns a week, at least based on those. So it's a good way to utilize some of those marketing items that are available to you as an agent. We've got a good website. You can go to our www.imsinc.com. It's got some great tools you can utilize on there for marketing. You can look at doing industry links. Maybe you want to look up AM Best report on a client or an individual. Maybe you want to look at our current annuity rates, life insurance quoting devices on there. You can look at long-term care grids. We have all of our current annuity rates on there. You can download the spreadsheets, have those available at your leisure. We have different forms, so maybe you want to download some application packages from a specific carrier. You can get those, and some really good information you can utilize based on what we have available there on the website. So make sure you are aware of our website. I know we've had it out there for a number of years. We've tweaked it here in the last few months. It's got some good additions on there and some good sales ideas. We've got some good support, training, whatever you may need to utilize to advance farther into the system. We also offer the Retirement Analyzer software package. It's a great system that agents use with clients, and it's got some great resources for really nice presentation you can utilize when you print out the information for your client. And it's got a good fact finder you can utilize to fill the information out on the system. You can plug in some different happenings, maybe a premature death or a nursing home stay, looking at what their money needs will be down the road, what kind of retirement they're looking at right now based on their current savings, and how much they really need to save between now and retirement to really focus in on, the standard of living they want to have down the road. So really nice program to utilize. I know we have this available free of charge to our agents as long as you're licensed and doing business. Marcus Solar is our expert on that retirement analyzer. He does a great job on that end, and it's a good system we've got put together for that. So definitely keep that in mind. We also have a wealth management side of our business now. We have a group that works on that side of it. If that's something you have some interest in getting involved in, I just launched a quick poll. Make sure you get your votes in if you would like to look farther into that wealth management side of our business or not. We do have 5 people that work in that department. We got a couple really good marketers on that side that can help you out with some platform designs, taking a look at getting your Series 65 passed, whatever you may need to get done, they can help you out with that. If that's something you have some interest in looking at, we'd be glad to get you started. We've got a good system you can utilize if you do not have a securities license. Maybe when you get your Series 65 taken, they can help you out with that and also help you out with any other questions you may have. You can talk to Charles or Mike. They're both very capable to help you based on that side of it. I know we've seen that block of business really jump up the last couple of years based on what's happened in the market, what's happening with agents becoming more diversified, maybe doing, some on the security side, some on the insurance side. it's always good to have all your bases covered. That way you're not referring people down the road and then you end up losing those clients because the other person could do more for them than you can. It's never good to refer someone and lose that client based on that relationship. So keep that in mind on your side. And I'm going to go ahead and close this up. If that's something you do have some interest in, we'll be glad to get that over to you and get that taken care of for you. We will be going through some products here shortly. Somebody just had availability in New Jersey. I'm sure we'll get that straightened out by Craig here in the next few minutes. I do believe that a lot of the Lincoln financial plans are available in New Jersey, so we should be hopefully be good to go on that side of it. We also put on our life and annuity academies. We do these typically 3-4 times a year. I know in 2020 we've been kind of restricted on what we can do based on the travel restrictions and the pandemic. Really, it's a situation. Probably won't be doing any of these till the beginning of 2021. If that's something you have interest in, it's an all expense paid trip. We usually use 2 nights, 2.5 days. Bring in like typically on a Wednesday afternoon. It goes Wednesday, Thursday all day, Friday morning. You'd fly back Friday afternoon. We'd go over different sales concepts. We'd go over both annuities and life insurance. We got some great programs available there and a good option for you to utilize those strategies that you learn at the meeting and take those back home with you and utilize those at your current location. And we fly you in, we take care of your meals, your lodging, everything's paid for. Basically, you just have to get to the airport or drive in. We pay for your mileage. We go over some really good sales information. We bring in, say, 3 or 4 of our top producers. They go over some sales ideas of what they do in the field and what they utilize with clients. They got some good presentation information they'll be going over. We'll also go over some software information utilizing the retirement analyzer. We'll be looking at some other software we do have available on our website. Cover some advanced annuity topics, high-end life cases, indexed annuity strategies. We'll go over a wide gamut of information there for you. If that's information you'd like to look at, definitely check off yes. So I'll leave this up for another 10, 20 seconds. We'll go ahead and close it up here shortly. But if you have interest in coming out to one of our academies, we'd love to have you out to one of those and get you up and running with us based on that. And it's also a great way you can get to meet some of the IAMS staff and also be able to possibly meet some of the home office personnel based on where we hold these meetings. I'll go ahead and close that up here and get that put away. But if you do have interest, we'll be announcing dates probably the end of this year for the 2021 initial meeting, and then see what we can do going forward into 2021. We are glad that we are going to be joined here by Craig Geiger. Craig is one of our reps here from Lincoln Financial Group. Does a great job with them and does a good information I'll be passing along here this morning. And are you on with us this morning, Craig?
I'm here.
Good.
How you doing, Matt?
It's good to be there, and I am here, doing well this morning, sir. I'm gonna go ahead and you have the information we changed presenters on the site here?
I do.
Okay.
I haven't gotten it yet, but I will, I'm sure.
Yep. I'll go ahead and get that shared. Your screen is now up on my screen here, Craig. So you are good to go there. Are you in Chicago this morning?
I am in Chicago this morning. Yeah.
Good for you.
So, luckily the weather's good.
Much traveling these days.
No, I have not been on the road for 5 months, so this is definitely a little bit different type of environment that we're all in. But hopefully things will work themselves out with coronavirus, and things will be back to normal soon. So,
right.
Matt, can you see my screen? I just wanted to make sure you can see my screen.
I can see you. You're loud and clear. And then I did have a question that came up. Is the Opti blend that's available in New Jersey? Is it not?
Yes.
Okay.
Yes.
I've got a gentleman on from New Jersey that asked if it's available in his state, so it is available in your state.
It's not available in New York. Not available in New York, of course. Not a big surprise there, but yeah.
Exactly. But he could pick up some good information on this presentation that's available there in New Jersey, so we're good to go.
Well, perfect. Well, hey, Matt, Thanks again for the opportunity. I know at Lincoln we really do appreciate the partnership and want to thank all the advisors for taking time out of their practice today. I know you're very busy now that things are starting to open up a little bit. You can get in front of clients. The time is very valuable. So we definitely recognize that and appreciate your time. So really what I wanted to do is to kind of jump right in. If you think about it right now, I think when you think of COVID-19 or you think of the pandemic, I think it's unprecedented uncertainty, if I was going to phrase it into something. And that's really, if you think about it, really what's dominating is the fear. It really elicits a strong emotional response and a physical response from clients right now, because a lot of times they're stuck in their tracks because of fear. They're concerned about losing money. They're paralyzed from making financial decisions right now because they're really not sure where the market's going to be. They're really unsure of when the coronavirus is, when we're finally going to get a vaccine, when are things going to kind of get back to normal? Is this the new normal? I think a lot of people are certainly asking themselves that question. So if you think about it and you think about, where people are going right now, there's over $5 trillion sitting in cash. In fact, Fidelity had a study that was done just recently from March of this year till about the end of June, said that about 1/3 of all clients aged 65 or older sold all of their equity positions during coronavirus. And I think a big part of the reason they did that was because of fear, the unprecedented uncertainty that is out there right now. And I think a lot of clients can fall into that category of unsure what to do. The question is, do they stay or do they go? Do they stay in cash and earn nothing? Or can they look at other alternatives versus going all the way in the market and sure having all the unlimited upside, but having all that downside risk too? So if you think about it and you think about, where things have been going, people are kind of focusing on all the money that's going in cash now, but actually, believe it or not, this was started back in 2016 when there was $3.5 trillion sitting in cash. So this process or this direction of going toward cash kind of started in 16 and kind of made its way, especially during coronavirus, and we've seen a $1.5 billion spike in cash. And of course, when you think about where clients can tend to look for a yield, if you will, right now, the usual places they would go, like CDs, which we know the rates are horrible, money market accounts, the rates are even worse. And if we would look at fixed income, which usually is always a part of a client's portfolio, that usually is the defensive part of their portfolio next to the equity side of it. Usually that is there, and that gives you some type of yield. But the analysts say over the next 10 years, fixed income is projected to be somewhere between 2 to 3% over the next 10 years at best. And on top of that, you're certainly going to have a lot of other risks that are going to be associated with what's usually supposed to be a safe investment or a conservative investment in a client's portfolio, because of course now you got to take into account interest rate risk, principal risk, and the biggest thing we're talking about now, of course, is credit risk. And so the question is, why now? So we're going to talk about why now, now is the time to act. How does it work? And of course, why Lincoln? So if we think about it, and we think about kind of where we are in the marketplace right now, think about this one question you could ask a client or even ask a room of prospects right now because of where we are today. If you could have 3 wishes or you could have 3 attributes you'd like to see in an investment today, what would they be? And usually the big 3 that we always hear is protect my money, grow my money, and I don't want to pay any fees. Very rarely can you find an investment that checks all 3 boxes, but an index annuity actually does do that. It does protect the money. It does grow the money and give them more upside potential than what most fixed income investments can currently pay, and there are no internal expenses. So certainly, when you think about that, you think about the fact that the 2 emotional drivers that are driving investors, whether it's during coronavirus or even during the bull market, is the fear of loss and the fear of lost opportunity. Clients want to have the ability to be able to satisfy their fear of loss with some kind of guarantee on their principal, but at the same time have some upside potential so they don't feel like they've completely lost on opportunity or upside that's going on in the marketplace today. Now, one of the things that really has been going on, and that certainly is getting a lot more press recently, is the impact that bond prices and interest rates are going to play, especially over the next 10 years. Nearly half of the over $5 trillion sitting in the U.S. corporate bond index currently, believe it or not, is BBB rated. And the reason that's important, ladies and gentlemen, is that means it's one downgrade away from being junk status. And that's very important because obviously that's going to impact the yield cushion, rising interest rate potential risk, and of course, the rising credit risk that we're seeing. And I always get the question from advisors, where is the opportunity for me? Where's the money, if you will? And if you think about it, the opportunity really is, if you look at the global fixed income market today, the global fixed income market is over $109 trillion. There's over $109 trillion in the global fixed income market. There's only $76 trillion in the global equity market. So everyone always assumes the equity market is going to have more assets, but in fact, the fixed income market has more. And in the U.S., of that $109 trillion that's in global fixed income, $41 trillion is right here in the USA. So certainly there's a lot of clients out there that might be looking for alternatives when it comes to a fixed income or bond fund alternative. And I'm seeing a lot of advisors having a lot of success right now de-risking that part of the portfolio by taking away that interest rate risk, that principal risk, and more importantly, again, that credit risk. And we all know that obviously it can have a dramatic impact based on where rates go over the next 10 years. So if we look here and typically just think of a 1% coupon rate on a $1,000 bond value, obviously if interest rates go down, that's obviously going to have a positive impact on your bond. But if interest rates start to rise over the next 10 years, as we can see here in this chart, it can start having negative connotations to those bonds and obviously being able to reduce the value of those bonds over that time. Now, obviously, when we think about, where we are right now, it's all about, the power of protection, the growth potential, and more importantly, the no recovery needed. So the power of protection, obviously, the value proposition of an index annuity is the fact that the worst you can do is zero. Zero is my hero. If I start out at 100,000, I know that I've got that protection barrier in place that gives me peace of mind, that allows me to get back and invest in again versus sitting in cash or even in CDs right now. And of course, growth potential. Obviously, we want to have more growth potential than what other safe investments are currently paying. And more importantly, no recovery is needed. Obviously, when the market doesn't cooperate, the market's down, it's not going to impact your previous year's gain. So I did some math. If you think, it's just kind of take into account a $10,000 investment that was invested in December of 2014 to the end of December of 2019, that $10,000 in the S&P would have grown to $36,418, or about a 9% average return. Now, this is where it gets interesting. If I missed the 10 best trading days in that period of time, my $10,000 would have only grown to $18,358, or about a 4.13% average return. If I missed the 20 best trading days in that period of time, my $10,000 would have grown to about $11,908, or about a 1.17% average return. And then lastly, if I miss the 30 best trading days during that period of time, believe it or not, my $10,000 would actually be worth less. It would be worth $8,150, or a negative 1.35% return. The reason I bring this up is because with a fixed index annuity, you have the ability to capture some of the upside. You have to lock in your gains and start fresh the next year, and that's important, which really goes right into what I wanted to talk about today, and that's really our one-year S&P 500 daily risk control spread. I know that's a mouthful, but really the simple of it is it's a uncapped strategy. But more importantly, when uncapped or volatility control indexes came out years ago, a lot of them all have either an equity component as well as that bond component, of course, that offsets volatility. Now, as we know, as the years have gone on, those bond portions can take up a big chunk of the overall index. So maybe only a portion of that money is actually going to the equity side or the S&P 500 side. So we decided to do with this index, which is very popular right now, especially with investors or advisors that are looking for something to give their clients more upside potential if the market really starts to take off. This strategy is different in the sense that it's 100% in the S&P 500, and if volatility gets above 5%, money moves to cash, and then once that volatility settles down, it goes back to the S&P 500. And more importantly, you get the dividends included in the calculation. And I'll tell you why that's important in a second. If I think about why dividends play such a vital role, let's look at two different scenarios where dividends really made a dramatic impact. If I look at scenarios like that are kind of similar in some ways to now, I think of the 1930s. The 10-year Treasury was below 4% during that period of time, and actually over 34 years, including all of the 1930s. Now, the 1930s, at the end of that decade, the S&P 500, believe it or not, was negative, but dividends averaged about a 5.4% average return. So when performance wasn't there, dividends were there to help kind of pick up the slack. If I look at the 2000s, which of course we all know is the lost decade, again, the S&P was negative during that decade, but yet dividends almost had a 2% average return. So again, when the performance wasn't there, the dividends were there to kind of help pick up the slack. And if I go back 30 years in the S&P 500, I look at that, over half of that return was made up in dividends. So again, the value proposition for you as a client today is the fact that they can get uncapped upside potential in the S&P 500. It's S&P 500 and then cash if volatility gets above 5% minus a spread. And the spread currently on our Opti Blend 5 and Opti Blend 10 contract is a 3% spread. So let's just say the market does 10% over the next 12 months. The client would get the ability to take that 3% spread and then, of course, net the difference. So it's certainly a great value proposition for clients that really want to maximize and get more upside potential if the market really does rebound, especially if we have found a vaccine for coronavirus and things start kind of getting back to normal. Now, lastly, I just wanted to kind of wrap things up with really, not just so much about product and not so much about the index, but really about the environment that we're in today. And, I've been in this industry for over 20 years, and I know a lot of people on this phone have been in the industry even longer than me. Now, I want to share one quick story, and I think it's really something that can resonate with everyone here on the line, and that's really the Model T. If anyone knows what the Model T is, that was the first car invented by Henry Ford. In fact, it's considered the most influential car of the 20th century. Now, Henry Ford conceived this to be a low-cost, durable, versatile car, and of course, as everyone knows, it was a massive, massive success. In fact, years later, the Model T was very popular, but over time, though, their sales started to drop because it started to look dated and it was not keeping up with the competition. And as we know, over time, that competition started to take away a lot of market share by the 1920s, and consumers had about 10 times more choices than they did when the Model T came out. Now, Henry Ford was hesitant to change, even as the market and the technology around him evolved. And by 1927 was the last year of the Model T, which of course was replaced by the Model A. So the messaging here is we are now in a very weird market environment where a lot of times, a lot of us kind of have to reinvent ourselves. We have to find new ways, embrace new ideas, embrace and utilize technology, and look for new markets and new ideas. And the great thing is by partnering with IAMS, you're getting that back office support. You are getting those sales ideas. You are getting that technology and sales strategies. And at Lincoln, we're here to help give you competitive products to help your clients grow their retirement assets, especially during this pandemic. So with that, I'm going to throw it back to Matt and see if there's any questions.
Hey, thanks a lot, Craig. I know that I just launched a poll for people that want to get additional information from us on Lincoln Financial. I'm going to go ahead and send you some details on the Opti Blend, also send you the rate sheet along with the licensing paperwork. So if you want to check off yes or no on that, I'd be glad to get some information out to you. And that can be emailed or mailed. I'm going to follow up with everyone that's on today's call and see if you would like to get some additional information out to you via email or mail. But if you need to have another 10 seconds, we'll leave this poll up. Appreciate the information, Craig. Another question did come up. Does the Opti Blend have an income rider on that, or is that accumulation only?
So currently it's accumulation only because of the interest rate environment that we're in. So I think once interest rates get at least above 1%, we might see some of our income riders come back. It's just unfortunately in this environment, they're very, very hard to price. So the company made the decision to go accumulation only for now. And then again, as interest rates start to rise, I think we'll most likely bring those back over time. One thing I did not mention, and this is not around product, but in terms of for the advisors on the line, the one thing I did want to point out though, that Lincoln does dual appoint. So if you are doing Lincoln business, but you want to be able to start doing your Lincoln annuity business with IAMS, you do not have to get a release to do it. So you can get just a brand new agent number with IAMS and be able to start writing right away. You don't have to worry about any kind of a release. I just wanted to make sure I pointed that out.
Yeah, appreciate that. Another question came up on the dividends. Are 100% of the dividends included in the S&P return?
Yeah, they're calculated into the return. In fact, let me do this real quick. I'm actually going to bring up, there's a sales piece that we have. Just let me know when you can see it.
Okay.
Okay. So what I want to do here is I just want to show them the piece here. So
sure.
If I can go up here. Sorry, this piece is not moving up. Here we go.
Yeah,
So
do you know what kind of
real
return that you've been illustrating at on this specific strategy there, Craig?
Yeah, you can go back as far as 30 years on our illustration software if you want to show 20, 30. But yeah, it is very customizable. Again, I want to point out that the piece though is this strategy does not include bonds, which is really, really important, but it does
Right.
include the dividends, so they're calculated into the calculation. So.
Sure. And this shows us what the returns have been in 17, 18, and 19 based on the dividends included.
Correct. Correct.
So in 17, it was pretty much 15%,
Yes,
as opposed to
almost a
S&P, which was
75%
19.4.
Correct.
And then 18 didn't drop much. I mean, it doesn't matter if it dropped at all, you're still getting zero. But in 19, we're at over 10, and with a 3%, spread, you're still looking above 11 and 17, and above 7 and 19. Do we have any numbers year to date on 20 here, Craig?
I don't have those numbers in front of me, but the great thing is though, this does have its own ticker symbol. So the great thing is, if you look here, it's SPXT5UT. If you go to the S&P 500 or USFindices.com, it does in fact have its own ticker symbol. Has all the information. You can do back testing on it and be able to see kind of how it's done over the years.
Right. So yeah, there's another question came up. What kind of returns can this potentially get? So, based on what Craig has up right now, I mean, you can look at returns above 10% if you have a really good year, which 17 had.
Right, because the biggest feedback I get from advisors are the ones that say, listen, I think once coronavirus, we get this vaccine, things kind of get back to normal. I think the market's really positioned to do well over the next couple of years. What's going to give me the greatest upside potential? Well, certainly getting things that are uncapped help, but also getting the dividends calculated is important as well, and having the ability to lock in gains along the way. And I think this index really helps check the box on a lot of those things. And even more importantly, it's very transparent. It's very easy to explain to the client. You're getting 100% participation. Whatever the index is going to do, we take the spread out and you net the difference. And then you start fresh the next year. So very simple to explain to a client. Not a lot of moving parts.
And then they can actually spread their money, the client's money, over a couple different indexes, or 3 or 4 if they want to do. And that Fidelity strategy is another good uncapped strategy they could take advantage of. You've seen some pretty good history on that one also, haven't you, Craig?
We have, yeah. That one's been very, very popular. Certainly the par's come down a little bit recently just because of where interest rates are. So really we've seen that a lot of advisors are pivoting more back to the S&P 500 daily risk control because, again, if they're looking for something that's priced competitively, that has a lot of upside potential and includes the dividends, this is a great alternative to that.
Right. What's the current par rate on your S&P volatility control? What's that par rate at now, Craig?
So this particular strategy that we're looking at right now has a spread. So you get 100% par minus a 3% spread on a $100,000 deposit.
Yeah, and I actually prefer that as opposed to the par rates, because if you had a 50% par and the market was up, 15%, with the par rate you're only gonna make 7.5, but with the spread you're gonna make over 11. So, with the spread, that really equates to some higher returns there, especially in the years where the market has some pretty good returns.
Correct. Yep.
So if you blend this with the Fidelity strategy, I think your client's going to see some pretty good returns there. So, anytime you can earn 100% par on that S&P volatility index, that's a nice combination.
Yeah, and one last thing I probably would say, because I know a lot of times people say, well, did the clients really invest in the S&P 500? Do they look actually at other indices, which of course they do. But one thing to take note, though, the 4 largest mutual funds in existence, Matt, is the Vanguard 500, the Spider 500 ETF, the Fidelity 500, and the Vanguard TM Fund. They make up over $1 trillion in assets. And if you think about it, the one thing that 3 out of the 4 of those have all in common is they all track the S&P 500, and none of them have any downside protection. So this gives them the ability to have an alternative to that to get uncapped upside potential minus the spread, and have the ability to lock in gains along the way.
Right. Yeah, another individual asked about compensation. I know that the Lincoln's compensation is very competitive. When I give everyone a call, we'll go over the compensation on the Opti Blend series. They've got, is it 5, 7, and 10? Craig, is those the durations you have?
Correct. Yeah. So the 5 being competitive for advisors that do AUM that are looking for a bond fund short-term solution, or the OptiBlend 10 tends to be probably the most popular though. But the
Right.
pricing on both of them are 3% spread on the volatility control index. They're the
Well,
same.
good. So Lincoln does have some different options there on duration. So if you got a client that's a little bit older, they may want to go shorter term. They got that 5-year option on the plan. Otherwise, you got someone that is maybe younger or looking for the maximum results. That 10 year is probably a nice option for them. And you guys have 10% free available in the first year. Is that right, Craig?
Correct. Correct.
Yep. So 10% free withdrawal starting year 1. So you got good liquidity there. You've got some good return opportunities there. So really a nice combination right now. Well, I do want to thank everyone for joining us this morning. Went a little bit over our time I just suggested earlier, about 5 minutes over, but we do appreciate you spending time. As I mentioned, I'll be calling everyone sometime today regarding this webinar we held this morning. We greatly appreciate your attendance. If you have a specific case in mind you want me to quote up, I'm glad to get that done for you today, get that right back in your hands. We look forward to a really strong next couple months in business. I know we've seen some nice increases here the last 2-3 weeks on business coming in. So it seems like more agents are getting out there in the field and being able to meet with clients individually. So nice combination there. Otherwise, Craig, you have yourself a great week. Appreciate your time this morning. Anything you want to wrap up with this morning, Craig?
No, that's it. Thanks again for your time. I really appreciate it. Hope everyone's safe.
You got it. Stay safe, and we'll talk to everyone here shortly. Bye now.